Hi all. To begin with, do you know which company is undervalued or cheaper? Do you know when is the right time to buy a stock or to get more profit? Or do you know which company has high future growth? If you don't know the answer, then watch the video fully. And by the end of the video, I am sure you'll be able to answer these questions. Let us assume you're going to a textile shop to buy a shirt and the cost of the shirt is 2000 rupees. Later, you found the cost of the same brand shirt in Amazon or Flipkart to be 1500 rupees. Then, how would you feel? Definitely, we'll feel that we have paid more for something that is available at a cheaper price. To avoid these regrets, in stock market, there is this amazing ratio called as P ratio. It is also called as superstar of financial ratios because every investor likes to check the P ratio before investing. Let us see about P ratio in detail. PE or price to earnings ratio. The name of the ratio itself tells us that it is current market price of a share divided by earnings per share. Current market price means the present market price, which changes every second during market hours. EPS, that is earnings per share, means how much earnings does one share yield. EPS changes every quarter. I have already posted a video on EPS, so I will suggest you to watch that first. I have pasted the link for EPS video in the first comment. Let us see an example for PE calculation. Let us consider Dr. Reddy's laboratory, whose current market price is 5728 rupees. This is as on 19th September. And its EPS is 283.64 rupees. All these details are taken from screener.in website. Now we apply this formula we saw earlier. PE equal to current market price divided by earning per share, which is 5728 divided by 283.64, and that gives us 20.22. So what does this 20.22 tell us? It means to earn rupees 1 as profit from Dr. Reddy's laboratory, you have to pay 20 rupees. That is, EPS of Dr. Reddy's laboratory is 283.64 rupees. So you should pay 20 times more money than its EPS to get one share. That is 283.64 into 20.22, which gives the current market price of Dr. Reddy's laboratory, that is 5728 rupees. I hope it was clear. If not, please let me know in the comment section. Let us now try to answer this question. Which company is cheaper? Sun Pharma with a current market price of 1147 rupees or Dr. Reddy's laboratory with a current market price of 5728 rupees? If you look at the current market price alone and choose Sun Pharma, it is incorrect. You must check for the company's PE to find the cheapest stock. Here, Sun Pharma's PE is 31.2, whereas Dr. Reddy's laboratory's PE is 20.22. So it is very clear that Dr. Reddy's laboratory is cheaper compared to Sun Pharma. As I say in my earlier videos, we should not blindly pick a stock based on PE ratios. As we saw companies can manipulate their EPS in earlier videos, we should also consider few more parameters in the balance sheet. I will explain that in upcoming videos. So please subscribe to my channel and press the like button. How to find a stock is undervalued or overvalued? First, check its PE with industry PE. Let us consider Dr. Reddy's laboratory itself, which belongs to pharma industry. Pharma industry PE is 30.6, whereas Dr. Reddy's PE is 20.22. As Dr. Reddy's PE is lesser than its industry PE, so this stock is undervalued. If stock PE is lesser than industry PE, the stock is considered as undervalued. If stock PE is equal to industry PE, then the stock is fairly valued. If stock PE is greater than the industry PE, then the stock is overvalued. But in cases of many blue chip stocks like TCS, whose stock PE is more than industry PE, because investors strongly believe the future growth will be very good, so they are trading in a premium price. In this case, you check the 3-year median PE. Here, TCS median PE is 29, but its present PE is 30.1. It is slightly overvalued. Generally, we can prefer to buy a stock if stock PE is lesser than median PE. It will be good to buy if only all the other fundamentals are strong. Have you ever observed stocks with negative PE? What does it mean? Negative PE means that the company is either sitting in a huge loss or is not making any profits. What are the different types of PE? First is forward PE, and the second is the trailing PE or trailing 12 months PE or TTM PE or current PE or stock PE. What is TTM PE? Trailing 12 months PE is used for calculating the financial performance of a company based on its current market price and its EPS over the past 12 months. The TTM PE can be calculated as the current market price divided by the earnings per share for the past quarters. TTM PE is readily available in Screener.in website. It is also called as a stock PE. The formula that we saw above is just for our understanding. What is forward PE? It is calculated as current market price divided by the company's expected EPS for the next 12 months. In stock market, results will be announced in quarterly manner. So EPS will be calculated for the next 4 quarters. So the formula is forward PE equal to current market price divided by expected EPS for the next 4 quarters. The forward PE is also available in sites like Yahoo Finance. For example, I have fetched the forward PE for Dr. Reddy's laboratory, which is 20.16. What does forward PE indicate? If the forward PE is greater than the TTM PE, analysts would generally expect a decline in the earnings or decline in EPS, which is a bad sign. If forward PE is less than the trailing PE, analysts would expect increase in earnings or increase in EPS, which is a good sign. But remember, these calculations are purely based on expectations or forecasts, so there are chances of it to go wrong also. Thank you for watching my video. Please remember to subscribe to our channel. Also, please press the like button and share it with your friends and relatives. Thank you.